Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Christian Nolting, the Global Chief Investment Officer at Deutsche Bank Private Bank, writing, with inflation appearing contained and labour market cracks emerging, the Fed is bound to pivot from its cautious stance and begin easing in September. Christian joins us now for more. Christian, welcome back to the programme, sir. I think we all understand they'll be cutting interest rates on Wednesday. All looking for that 25 basis point reduction. Christian, the question we've all got is what happens after that? What are they allowed, what can they ultimately forecast and guide to for 2026?
Yeah, so I think we all agree on this probably cut. So the question is 25 or 50. I would be really in the camp of 25 because why would you surprise the market, to be very honest? And if you go for 50 this time, I would say the market could also argue, do they know more about the labor market? Is it weaker than expected? So I think it's 25. And then, as you rightly say, there's more to come. I think there's room for the Fed to cut. We would expect over the next 12 months, way into 26, as you're saying, we expect 5 cuts, so a bit less than the market, because we think there's still some inflation pressure, not massively going higher. But I would say it's 5 cuts over the next 12 months. And the market is, if I look at Bloomberg, 6 cuts.
Christian, forgive me for getting stuck in some of the small print, but I think we've got to. We'll all go to the summary of economic projections on Wednesday that gets delivered alongside the statement. And in that, at the moment, for 2025, they've got unemployment for year-end at 4.5%. And I'm just wondering how much has actually changed for a lot of people on the committee looking at the labour market. They don't forecast payrolls. They have to forecast unemployment. Has that picture changed that much?
Yeah, I agree, right? It still looks very close to being at, say, full employment in the US. But I think if you look at the trend, it's weakening a little bit. I'm not saying it's massively going higher. But I think what the market is also pricing is the Fed is doing something, not a recession, but they want to cut now. And from that perspective, that should be positive for the economy. And from that perspective, yes, we don't talk. And that's the big difference, Jonathan, to other cycles. Normally you cut into a fiat recession. That's not the case. And that's one reason why we say it's probably only 5 cuts, still a lot from my point of view, compared to the market who is maybe saying 6 or even more.
Christian, from an investment standpoint, does this make you more willing to go into U.S. assets because of the prospect potentially of faster growth, or flee because of the potential for faster inflation?
I think if you look at this year, 2025, it's very interesting. So it started with, being here in Europe, with a nice outperformance of Europe for the first time in many years, I would say. That has changed in the second quarter where the US came back. It's a lot about, of course, technology, AI in the US. I think that doesn't change. From my point of view, I'm not fleeing US equities at all. My question is rather, do we see a change in Europe? And maybe there's more room for upside in Europe as well. Because if you look at rate cuts which are anticipated, which normally is good for the market, if you look at earnings in the US, quite decent, right? Up 8% expected for 2025. And Europe is down 1%, and we do still hope for and expect some fiscal spending, maybe coming from Germany. And there's a lot of debate in Parliament this week, so maybe you see some results, and that could be also positive for Europe, not only for the US.
Hope doesn't necessarily, though, get the returns. And I am wondering how much you're seeing people double down on this Europe bet at a time where the US potentially could grow a lot faster because of rate cuts. And then you've got France getting downgraded over the weekend. You have, yes, this potential spend by Germany, but even the ECB is talking about a 1%, 1.3% growth rate over the next number of years. Are you suggesting clients double down on that European story, or are you saying, let's just hold out, watch, and keep hoping?
I would say we suggest to double down on Europe because we do expect fiscal spending. I agree the absolute number, 1.3, 1.2% growth doesn't sound very compelling. But if you think of the potential growth in Europe, it's roughly 0.4%, much lower than the US, by the way. And maybe you can bring this a little bit up with fiscal spending. I think there is room for performance. And as we see, Europe is clearly underinvested in many, many client portfolios from the US, from the rest of the world, from Asia. And interestingly, honestly, I get a lot of requests to explain about euro, and normally that comes with some money, which is then invested later, but it needs a trigger. And I would say now debates on fiscal spending, especially from Germany, could be a trigger that this gets more intention, and that probably could lead to some money flows as well.
Christian, language is important. You said especially from Germany. Is it exclusively from Germany?
I think most is coming from Germany, because obviously in France there's not so much room. Yeah, I would say look at Germany first, but it's the largest economy in the European Union. So from that perspective, I would expect some money to go into Germany, because that should be in the news with the budget discussions this week and next week as well. So from that perspective, maybe start with Germany. That's what we also tell the clients.
Who and what do you think benefits from that fiscal spending in Germany? We've already seen a monster rally in the European banks earlier this year.
Yeah, if you look from that perspective, right, so here the picture is a bit different, right? We do expect from the ECB not as many cuts as we do expect from the Fed. Max of one, where if at all, so it's a lower level, of course, ECB being at 2%, Fed much higher, of course. But if you look, we still have some inflationary pressures, not too much, but there's still a steep curve, and that's positive for financials. So that call we made quite some time ago is still on. From that perspective, we think it's quite interesting to still look into this. And many banks are still trading below book value. So from that perspective, it remains quite interesting given the interest rate environment we are in here in Europe.
That's the medium term. This week, I'm curious about the reaction function in markets. If we do get a signal from the Fed that they're going to cut more steeply, do you go out and buy gold?
We have already a lot of gold in the portfolios, to be very honest. I still like it. Our forecast, also to give you a number, is 3,800. So up from here again. It has been quite a call because there's so much discussions which currency you want to invest in. Of course, dollar, but everything in euro, probably also not everything in renminbi. No, that's why people look into buying gold. We think that's continuing. Central banks are buying gold, but also retail investors are looking into this. I think the trend will continue, but we have already quite a portion of gold and enjoying quite a nice rally. But as I said, we think that could continue as well, with our forecast being 3,800.
Underlying that question is this question about government bonds and just the developed markets, whether they still count as the haven asset. Do you view the rally that we've seen in long-term bonds, particularly in the United States, not necessarily in Europe, as reaffirming this quality of the securities at a time where there have been a lot of questions?
Yeah, I think it's quite interesting. I've just discussed with a lot of clients that also if you look at corporates, that's quite interesting, right? Look at the size of some corporates and then the discussions about higher debt levels. What's quite interesting for me, what we have seen is US yields not moving higher. In Europe, you have seen some yields moving higher also in Asia. So there seems to be a lot of discussion about the US government bonds, but maybe at one point in time, I think if yields were to go to higher, maybe some Fed action can also be expected. On the other hand, if you look at Europe, France, of course, moving higher, better today, but there was also a downgrade. So I think, yes, it's still an anchor, but I think clients should also take into account the power of a lot of corporate bonds. And from that perspective, investment-grade corporate bonds, I think, is a very important trade clients should also debate.
Stay with us. More Bloomberg surveillance coming up after this. Traders betting with near certainty the Federal Reserve will cut interest rates by 25 basis points this week. Joining us to discuss, the former New York Fed President, Bill Dudley. Bill, welcome back, sir. Let's get straight to it. What are you expecting to see this coming Wednesday?
Right along with everybody else, I expect a quarter-point cut. It's baked in the cake. I'd be surprised if they do anything else.
Do you think they'll guide much beyond that?
Well, there'll be guidance because they're going to publish the summary of economic projections, which shows their interest rate outlook for the rest of the year and into 2026 and 2027. And I think the big debate there is, do they show one more cut after September, or do they show two more cuts? And I think it's going to be a very close call between those two outcomes.
Yeah, Bill, I think we should build on that. That's the interesting piece of information for me. That at the last meeting, the last round of forecasts, if you will, they were forecasting two cuts, and they had unemployment year-end at about 4.5%. And Bill, we could have this really strange situation where people are basically looking for the unemployment rate to stay steady in the forecast, but all the dots to come down. Bill, just what's happening there? What is actually driving the outlook for rate cuts? If it's not unemployment, what is it?
Well, I think you're right that the forecast is evolving pretty close to what they had the last summary of economic projections in June. So if they're on the same forecast track, why would they pencil in more rate cuts? I think the thing that's changed is just this weakness of the labor market in the sense of payroll employment growth. It's only been 30,000 a month over the last 3 months. And you see a lot of indicators that the labor market is continuing to soften. So I think it's more the softness of a lot of the labor market indicators that are getting them concerned that the labor market could continue to deteriorate. So I think that's the biggest risk right now. And so that's what's causing them to have a little bit greater urgency.
Bill, doesn't the market agree with them? Isn't that the takeaway from the rally that we've seen in the long end of the yield curve?
Yeah, absolutely. I mean, market is in agreement that rates are coming down, not just this year, but in 2026 and 2027. In fact, the market, if you look at the federal funds futures market, it has rates coming all the way down to about 3% on the federal funds rate by the end of next year. So there's a lot of rate cuts priced in. I think, personally, I think it's not quite so clear that they're going to go that far over the medium to longer term because the financial conditions are already very, very accommodative and the economy is not falling out of bed. I also think we haven't seen the full effects of the tariffs in terms of prices yet. So I think, inflation is going to stay sticky over the next 6 to 12 months.
So I want to dig a little bit deeper into what you just said, the idea that the long end of the yield curve is pricing in steeper cuts. You could make the argument that if the economy isn't falling out of bed, that any steeper cuts would cause a reacceleration in inflation and potentially some deterioration in the dollar that could cause kind of the opposite in the long end in terms of a sell-off and a yield curve steepening. What's your understanding of why the market doesn't seem concerned about that?
Well, I think they think that the reasons for cutting now are actually quite compelling, given that the inflation pass-through from tariffs has been smaller than expected, and the weakness in the labor market has been at least as large as expected. So I think the market shares the view of Jay Powell that the downside risk to the labor market outweigh the upside risk to the inflation. So therefore, rate cuts are warranted. But I think the question is, how far are they going to go over the medium to longer term? That's where the markets, I think, may be a little bit ahead of themselves. Now, some of this, it's hard to factor in how much is the pressure of the Trump administration on the Fed and, some risk that the Trump administration could compromise the independence of the Fed. Now, obviously, if the Trump administration is successful in doing that, that's going to be lower rates, but it's also going to be higher inflation.
Bill, just to talk about what we might get from the news conference as well with Chairman Powell, how difficult is it going to be for him to establish a consensus at this meeting? If you go back to the last dot plot, and things may have changed, but in the last dot plot, there were a big group of individuals that saw no cuts in 2025. And I'm just wondering how much has changed, not just for Chairman Powell, he's indicated a lot has changed based on the last few times we've heard from him, but for other members of the committee.
I think most people are going to go along with what Chair Powell wants because they're not in disagreement about the direction of rates. They're just maybe have a small disagreement about timing. Should we start in September or should we wait a little bit longer? So the fact that they're all in agreement that rates are going to be coming down, I think they're going to give the chairman what he wants at this meeting. So I'm actually expecting very few dissents on the side of no rate cuts, maybe 0 or 1. The other side of the equation is are we going to get 50 people supporting a 50 basis point rate cut? And I think the only person I'm expecting there perhaps is Steve Moran if he gets confirmed and is sitting on the FOMC on Wednesday afternoon.
Bill, do you think that it's healthy to have a character like Stephen Miron on the Federal Reserve, on the Board of Governors, to really foster a robust debate about not just whether to cut 25 or 50 basis points, but the overarching framework that the Fed is operating in?
I think it's good to have a diversity of views on the Federal Reserve to debate a lot of, the framework. I think the Fed could do quite a bit more in terms of developing a framework for quantitative easing and quantitative tightening, and I've written about that over the last few months. So I think there are things for the Fed to do. I think it's a little odd to have someone that's essentially on loan from the administration for 4 months to vote at 2 or 3 meetings. So I don't think that Steve Moran is going to get a lot of deference at the meeting this coming week.
Bill, for people who aren't familiar with the meeting, a meeting that you've been a part of many, many times, can you describe to them what that kind of room will look like, that situation, how the meeting actually progresses, who runs things, and what kind of opportunity Stephen Miron would have as he sits around that table to make his points?
So the meetings typically are obviously chaired by the chairman, and there's typically a discussion about the economy. Everybody goes around and gives their views on the economy, and then there's a discussion about monetary policy. Everybody goes around the room and talks about their views on monetary policy. So Steve Moran will have a chance to speak on both of those, but he's going to be only one of 19 people speaking. The idea that he would go there and dominate the meeting, I think his influence is going to be quite small.
But do you take it in turns? Are there any kind of debates at all, or do you just go around one by one around 19 individuals?
No, there can be some back and forth. People do respond to what other people say. But I mean, remember, everybody's looking at the same set of information. So the disagreements tend to be small, more at the margin rather than large, because everybody's looking at the same set of information, hearing the same staff forecast, evaluating the same economic information.
Stay with us. More Bloomberg surveillance coming up after this. Abigail Watt of UBS writing the following. Here's the quote. We expect the FOMC wants to signal a series of rate cuts. We expect a total of 100 basis points of rate cuts this year. Abigail joins us now for more. Abigail, good morning.
Good morning.
This year as in the rest of 2025?
Yes.
Okay, quick maths. I'm a simple man. 3 meetings, 100 basis points. You're expecting a 50?
Yeah, so we've been expecting that the Fed would deliver 100 basis points of easing this year since April. So we had, after the Liberation Day tariff announcements, we felt that we would see it come to the fore that the Fed would have to make this decision essentially between kind of the potential for an uplift in inflation versus the weakness in the labour market. And we thought that would become most acute at this September meeting. And, we continue to expect that we'll see the 25 basis point cut delivered this week. Our expectations for the 50, we do have that penciled in for December. I think our sense is that we continue to see this weakness in the economy persisting. And it's something that, could actually accelerate as we go into the kind of fourth quarter of the year. I think one of the key things, it obviously retail sales, right? I think for us, one of the things that I would note is, you've seen a relatively weak consumer this year, right? You've seen the consumer running below trend so far this year. You saw July popping a little bit higher. So I do think that August print is going to be an important one, just in terms of getting a sense of how this consumer is faring.
So is 2025 going to be a mirror image of 2024 when it comes to 100 basis points of rate cuts into data that only gets better economically?
Yeah, so I think it's interesting because, we are expecting to see kind of more weakness in the labour market side, right? If we remember the kind of layoff program from the federal government side, you've got a slug of around 75,000 workers that are expected to come off the payroll at the end of the fiscal year. So that's going to dent your average, right, through the end of the year. So I do think there are signs that you'll continue to see that weakness in the labour market data. I think the key thing to note here is you've seen that weakness in the consumer, but you've not seen the impact of tariffs yet. Right? We're just starting to see some of those price increases coming through for consumers. We saw reports, obviously, from Walmart recently around potentially passing through some price increases in August. So I think that's why we're watching very closely, what's happening in this retail sales data this week, because you've not seen the kind of impact from the tariffs yet on the consumer. You've already seen a slow consumer. So the question is kind of when that kind of feeds through into kind of weaker real disposable income, as you start to see inflation reaccelerating, how does the consumer then respond?
Could you see a jobless reaccelerating? And I ask this given the fact that you've got companies that are investing more in automating different things, creating greater efficiencies, especially in the face of uncertainty with respect to policy. Could you see a pretty sluggish labor market even as corporate profits expand, even as people continue to spend?
Yeah, look, I think our sense is that we continue to see the labour market weaken through the end of the year, but then we think you will see a little bit of a turning point and into 2026. I think there's a number of things to look to in terms of the potential for kind of a more positive growth outlook through 2026. I just think that the kind of bite of the kind of tariff policies with the inflation pass-through will be felt through the kind of fourth quarter and into the end of the year. Our expectation then is, potentially you start to see some of the kind of fiscal impulse from the One Big Beautiful Bill Act kind of coming through. We should see that, in the April tax refund season. That's something we're watching out for, just to see how that feeds into consumer balance sheets, see how that helps consumers potentially weather some of the price increases we expect to kind of come through.
I have to say, I think that final point is still really underappreciated, because for a lot of people, they view the tax bill as an extension of current policy. Can you just sort of build that out for us? Why is that still so important? What kind of refunds are we expecting and why?
Yeah, so I think there's a number of kind of consumer policies around kind of child tax credits. Some of the focus from the campaign around tip income deductions, standard deductions for seniors being boosted. I think there's a number of different elements where you could see that potentially feeding through into a little bit stronger consumption through that period. I think the question is how sustainable that is. I think it would be kind of an impact through the second quarter, say. We have a little bit of a bounce higher in terms of the pace of consumption in our forecast in the second quarter, but then it doesn't necessarily mean that will be sustained. I think the other element that people are watching is obviously what's happening in terms of the investment side. When we look at the investment dynamics in the US just now, we are seeing kind of a very concentrated increase in investment in kind of AI-related goods and not necessarily a broad-based increase in investment. So I think the question is whether some of the extension, as you say, of some of the expensing provisions, does that then feed into stronger investment next year, potentially? We're a little bit hesitant, just given the extent of the response you saw in 2017. But that's another potential kind of boost that you could see. But overall, we still expect a relatively muted pace of growth next year. We're still below trend. We've got a 1.6% rate of growth next year.
Stay with us. More Bloomberg surveillance coming up after this. Looking ahead to the rest of this week, Greg Peters of PGIM has this to say. US macro base case is a muddle through. While downside tails remain, there is a chance of a mild recession. We see limited crash risk. Greg joins us now for more. Greg, welcome back. I'd love an update on where you are now, because the last time we spoke, you talked about the risk of a repeat of last year. The Fed was going to cut and maybe the long end sold off. We've started to see some stability return to the long end of the curve, Greg. Do you take some comfort from that?
Yeah, there's definitely been a reversal. The steady, unrelenting kind of steepener trade kind of reversed itself over the past week or so. But I'm not convinced that is kind of how it's going to continue to play out. I still think the risk in the system is for steeper curves, not flatter curves. You look at kind of where we are economically. You have, just talked about, the fiscal lift that I think you'll see. You'll see more monetary stimulus. You're seeing the effects of tariffs come through. You see a lot of, kind of the breaking down of institutional norms. All these types of factors, I think, will lead to more pressure on the back end. At the same time, though, everything will get pulled down. The question is, how will the back end kind of get pulled down with it? Will it be 1-to-1 or kind of 1-to-1/2, that sort of ratio? I just don't know.
This is something that we've been talking about here. How much is this just crowded positioning getting stomped out in terms of the yield curve flattening? I'm just wondering about the reaction function to Wednesday's announcement. If there is a real dovish bias to what the Fed does, do you see that curve steepening reinstating itself, or do you think that right now the market's just in a different frame of thought?
I think the answer is both, Lisa. So I do think there's an expectation that the Fed will just do 25, but, I don't think anyone would be completely shocked by, a more dovish bias here. That's where the markets are leaning. So that should largely be in the price. But I think it's important to note that the inflationary effects haven't really come through yet, from a tariff standpoint. And then if, in fact, this administration and this Fed is trying to kind of goose housing, then that's the area that has actually pulled down inflation, right? It's been a disinflationary environment on the housing front. So if you kind of do programs and policies to reignite housing, that should, all else equal, put pressure on the back end of the curve.
So what do you like right now? Are you just going into high yield bonds and cash?
Well, we like what we continued to like all along, and that's kind of the safe carry trade. So I think economically, the environment's in pretty decent shape. There is this risk that you can actually overheat in here, just given all the policies we just talked about. But for me, as a credit investor, I just don't see a lot of value, right? Credit spreads are pretty tight. So the bet that you're making to be really long credit in a beta way is that you have to go through all-time tights, which is a heroic bet in my mind. So it's about safe carry. kind of front to intermediate part of the curve. And I still think the back end of curves are quite susceptible here.
Greg, before you go, I'd love your response to this. It just came in from Neil Dutta of Renmac, just sent me a message and said the market has the Fed going to neutral 2 years before the Fed has it. They can't meet those expectations. Greg, would you agree with that? Is that the risk into Wednesday?
Yeah, but I think that's kind of a persistent risk, right? Markets always are ahead of where central bankers, tend to be. So I don't think that's a complete shock. You look at 1 year forward, you kind of have a 3%, which is, quite in the neutral range, if, even maybe a little lower than neutral. So I think get to neutral, see how the economy responds. The markets have a tendency of getting ahead of itself, par usual, and I don't think this is any different this time around.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.